It's been a while since I've gone over and had a special class on Fibonacci trading methods. Most of our Forex blog videos each day show Fibonacci's in action, how to use them as profit targets, how to use them to find entry methods. We also use them in our Elliott two-way Fibonacci pullback system to find a safer, lower risk entry into the dominant trend. And really, that's the key. You want to find the dominant trend, because the markets go up, they pull back a little bit, they go up, they make higher highs. An uptrend is a series of higher highs, higher lows. Downtrend, as you can see on this chart, is a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and so forth. Once the market goes above the last lowest high, then you might have a reversal, but it's not always the case. But nonetheless, we're going to use Fibonacci analysis. It makes a good place to look for trades. As you can see in this case, the market made a move down and found resistance at the 50% Fibonacci area. And you can also use, once you see, especially a double top here, at a 50% Fibonacci area, you can always go short once it starts going down or the bars go red here, let's say 3,200. And if you want to put your stop above the 62% retracement, even a pip or two above that, if the trend is going to continue, most of the time that very, very tight stop is not going to get hit. So one of the reasons I love fibs is not only they give you your profit target in advance, so you can calculate what your risk is, let's say 10 pips, your profit target. In this case, let's say it's down here at 70. If you went short here, you have a 30 pip potential profit while risking 10 pips. So that meets our requirement of the minimum 1.5 times bigger likely profit than risk. And new traders should focus on trades that have a 2 times bigger profit than risk. And you can always, when you're looking at these areas, you can get into the trade and kind of move your stop down or use trailing stops. You get out here, get back in again here, and then in this case, it continued and made more. Sometimes profit targets get passed, other times they're not hit, and other times the market reverses almost to within a pip of that area. So let's say you got short right here, you have a small win, you're short again here, small win, short again here, and you're out. Maybe at that point you decide not to continue to sell it. At that point, you want to get rid of the last fib area, redraw it on your chart. And in my experience, when markets are so weak that they can't even retrace 38%, there's a very high odds of that trend continuing. So if you drew your fibs on here, it wasn't able to get to the 38% fib area. Now, our lower containment bands most of the time contain price. This is usually where the market kind of runs out of steam and reverses. The bigger the swing, the less likely it is to hit the fib target if, notice I said if it's underneath the lower band. So one of the things you want to do if you want to look for a short right here is find a smaller fib area to find a much more high probability area where the market is likely to stall at. This is a much smaller fib swing from 90 down to 30. It's a 60 pip move versus an 80 pip move, and therefore the fib target's much more likely, because it is underneath the lower band, to be where the market stalls. So if I were looking to get short right here, my stop above the 62% retracement to be safe, this is my profit target at 12. So I might have entered this trade at 44. And a lot of times I put my stop personally above the 50%. I don't have it all the way up here because I don't mind losing 10 pips, getting right back in it, and usually the second trade gets my loss back. I can always trade more lots and so forth. So in this case, you're short at, let's say, 40. We'll round down to 40, out at 10. That's a 30 pip profit while risking 10, 15 pips. So it meets the risk versus reward criteria. And you can use our statistical tools like the containment bands to more intelligently use Fibonacci's. Most of the time, price does not go outside of the containment bands. And so as you trade with our software and tools, you normally see maybe 10 to 15 pips underneath there, then it reverses 10 to 15 pips, or it goes sideways. It usually doesn't, maybe 1 out of 5, 1 out of 10 days, does it go significantly beyond these containment bands. So again, draw your fibs on much tighter areas to get an idea of where the next profit target is. And I didn't draw that perfectly on there. There we go. And if it comes within a few pips of it, just look to get out there. Here's the pound dollar, and if you looked at our currency meter today, you saw that even though the pound has a very strong trend, earlier in the day it was one of the weakest currencies, while the dollar and the yen were very strong. So as you see this little sideways range, would be the high, this would be the low, and notice it retraced right to the 38% level. You have incredible weakness on the way down, and on the way up here you have less momentum to the upside. It wasn't even able to hit our extreme 80 level or go higher. So that's primarily the main reason method you want to look to trade. Find a strong trend that hits and hopefully exceeds the 80 extreme level, and then with a counter trend move, having roughly half the counter trend momentum, that the trend, this is a dominant trend. It's clear by looking at the chart. And you can use our intelligent trailing stops to get out, or you can just simply draw trend lines underneath the lows. You're short right here. If I saw a situation like this where the dotted red line is the previous day's low, this is also kind of a false breakout. Usually weak currencies, when they come up to the previous day's low, they're not going to go back above there. This one did, ran out of steam, and then came right back down underneath the previous day's low. Any trader that was trying to bottom fish and trade counter trend is going to get really nervous when it goes back below the previous day's low. So that's another, sometimes you might want to wait 3 or 4 or 5 pips for a price to break a support area before you actually enter your trade. It's going to increase your winning percentage. So you're short somewhere around 57.86. And if you just want to get out, again, it's underneath the lower containment band, so it's more likely not to continue. In this case, it did, but use our trailing stop right here. Maybe you're out around 60 here. You're short at 86. You made 26 pips, while risking maybe 10 or 12 pips. And as you can see, once you get into a trade, the trailing stop very quickly moves down to break even and into a profit. When currencies are underneath the lower containment band by so much, again, it's not as likely to go to the next fib target. Today it did, but most days it doesn't. You can see it went right to the 1.618 and kind of went sideways, went slightly underneath it, and it's just going sideways. Most of the time, price does not go beyond the 1.618 fib target. Here's an example with the euro yen. To start the day off, it found resistance at our hourly moving average. It pulled back, and this one wasn't even quite able to make it to the 38%. Most of the time, when the market is so weak it can't even get to the 38%, I found that the majority of the time it goes to the 1.382 fib target, which also, by the way, is way underneath our lower containment band. In this case, it had a little bit of a pullback right here. You might have gone short, made a few pips, or broke even, gone short again, and you can wait for the fib target to get out of your trade, or you can go short once it breaks the trailing stop here around 57, and you can see the trailing stop got you out down here around 80. So even if we round, it's about an 80 pip move. That gets rid of a lot of small 3 to 12 pip losses, one nice win like that. Even if you got out of it right here, which I most likely would have done myself, because it's underneath the lower containment band, it went down here, and it went sideways. I tend to exit half my trade, and at that point you can also draw your fibs on this last little tiny wave. I don't like tiny waves most of the time, but when currencies are not likely to go much further when they're underneath the lower band, doing so, it makes a lot of sense. You can always exit half your trade here and the other half right here when it hits the 1.382 of that smaller wave. This is a wonderful trade right here. You have a huge move down. Notice it retraced right back up to the 38% area. And on top of that, this is actually a resistance cluster. Anytime you have multiple resistance areas all within the same 10 to 15 pip range, you got the whole number, which tends to act as resistance. We have a 10-day moving average. We have 38% retracement, and it appears that there's a weekly pivot level right there. And right above that, we have the 50%, which isn't that far in the previous day's low, which usually when a currency is this weak, price does not go above there. So it makes a lot of sense. It's very smart to put your stop maybe at 27 right there. So you can see on this pullback right here, you're short out at 92, and if you got out when the trailing stop got hit at 63, at least you made 25 pips. In this case, it was one of the weakest ones. Our currency meter showed you that. The yen is by far the strongest, and it was also extremely weak. This is an excellent example of Fibonacci's in use. This is trending up. It's kind of going sideways. This is one of our sideways breakouts right here. You might have drawn your fibs from the bottom here to here. And most of the time the market's going to stall at the first or second fib target. In this case, it went sideways right at this area. More than likely, I would have personally been out of this trade here, but it's not above the upper 2.0 band. So when it breaks out again, you might decide to go long again, and you draw your fibs again from here to here. And again, like I said, most of the time, the 1.618 is the maximum move. So when this shot through the first fib target, when it broke above the previous day's high, the monthly pivot level right here, and the 1.382 fib, when it goes sideways right here and a lot of counter trend signals, you really want to get out of your trade somewhere up here around 80. So you might have went long here. Let's just round up to 60. You made 20 pips while risking maybe 8 to 12 pips. So it makes sense on the risk versus reward criteria. Also, this was quite a strong one. The daily trend's up, the weekly trend's up, the monthly trend's up. You have a nice little pullback right here. If you went long right here with your stop a few pips underneath here, or in this case, even a better stop would be a pip underneath the previous day's high. A lot of times, resistance once broken becomes support, so it's not likely to go underneath there. You always want to draw your fibs on the last wave up to get an idea, and look where it went. Just a few pips shy of that area. Profit targets are wonderful. If you went long even right here at 72 with your stop underneath here, you're risking 10 pips, 72 all the way up to 96. You're risking 10 or 12 pips to make likely, a likely 24 pips. So it's one of the main reasons why you should use fibs. Do they work every time? No, nothing does. However, they do work a very high percentage of the time, and they give you a nice clear roadmap of what your likely profit target is. So if the trade does work, you know in advance that you are likely to make 2 times, 3 times, sometimes 4 times more profits if it works than you'll lose if it doesn't work. And then just try to shoot for being 50% accurate or even 40% accurate if you're getting 2 times bigger wins. Think of it. $200 wins times 4 trades, that's $800 out of 10 trades. 6 losses would be 6 trades out of 10 losing times 100. That's $600 losses, $800 wins. If you get 2 times bigger wins than losses, you can make money even being right only 40% of the time. And as you see on the chart, once the market starts moving your way, trailing stop quickly moves in your favor. So a lot of times while your initial risk might be 10 or 12 pips, if it gets stopped out, you might only lose 3 pips, 5 pips, 7 or 8 pips. Rarely do you lose the entire amount budgeted. And that's another benefit of our trading methods.